Hey guys, and welcome to Monday Journey. In the last few weeks, I've been trying to read all the big banks research, all the news about the outlook for this next year, 2023. And with this video, I want to bring you all the important information so you don't need to read all the research, which is really boring for most of us. With this video, I will show you the outlook for the next year and the most important thing so you can be well informed and take the best decisions you can do it. So let's start. So first things first, 2022 was a difficult year. We had a big correction. We are down almost 20% in the S&P 500. We are trading at a forward PE of almost 17. So it's been a difficult, I know, but after being 20% down in 2022, are we already at a fair valuation for the S&P 500? We are close to 17 PE. It's been an average for the last 25 years. So, but if you think we are at a fair value, maybe it's a fair value for the S&P 500. But the market is like a pendulum. And the pendulum swings. Sometimes it's overvalued, sometimes it's undervalued. And when the crisis, recessions happens, the pendulum always swings from the one side to the other side. So maybe it's not. We will not stop at a fair value. Maybe we will go down even more. We don't know. We can't predict it. So it will depend on what will happen in the next months, years, so we will see. But at the moment we are at an average fair valuation, I think. So let's continue. For the S&P 500, we had above $200 of earnings in 2021. In 2022 we are expecting to end the year with 200, a small recession maybe. We didn't have the results for the fourth quarter, so we will see. And for the next year, analysts are expecting earnings of $225 per share. So analysts always tend to be a little too optimistic, in my opinion. It's gonna be difficult. If we can beat that earning, it will be really good for the market and for the economy as well. But I might not agree with that. But let's see. Maybe we still have a recession with all the debt rate increases that we have been experiencing. It might be difficult to grow earnings, but let's see, maybe between 200 and 225 we can predict that, but I think it's what most of us are expecting. About the S&P 500 profit margins, we had all-time highs in 2021. Margins were at all-time highs, close almost 40%, which is really good in the recent history, in the last 25 years. As you can see, margins are going down, which always happens in recessions. And with all that fiscal stimulus that happened in COVID, all the supply chain constraints that happened, that led to record margins. And what will be the margins for 2023? I don't know. Maybe we still, if we had a recession in this next year, maybe the margins will go even more down. Will be down even more. So let's see. So for the annual returns for the S&P 500, 2022 was one of the worst years in history. We were down 20% at the end of the year. We have been down for the S&P 25% in the October lows or June lows, I don't remember, but Nasdaq was almost 25% down, which is a lot. One conclusion that we can have is that it's really rare for the S&P to have 2 straight years of losses. It only happens once. It was in 2000 to 2001 and 2002. Actually, it was three straight years of losses. So maybe we can have a bull case. So if we were down in 2022, we'll be up in 2023. Maybe we'll still continue to make history, and we have 2 straight years of losses. So we don't know. We will see during this year. So about consumer confidence. Consumer confidence were at all-time lows. We peaked at 50, which is really low for the. If you analyze the history, we are still too low. This means that we are probably in a recession. So sometimes consumer confidence bottoms is good. It's the end of a crisis or a recession. Maybe we have a lot of upside. Just a good thing to watch. I think it can be good news. Maybe we are close to the bottom, and this is a good opportunity to start buying, to continue buying dollar cost average. I might continue to buy. I like the market where it is. I'm optimist for the future, so I think it's a good idea to continue buying this market, and I'm a bull maybe. Inflation is the most important thing at this moment. We have been such high inflation. That's really high. We haven't experienced such high inflation since the 1980s. It's really high. We haven't been at 9% since that time. But that's the bad news. But the news is that inflation already peaked and is going down considerably. We have peaked in June at 9.1%, but in the last report in November we was at 7.1 and going down. Rate increases are working. That's good news. And CPI is a lagging indicator. For example, shelter is already going down, houses is going down, rents are going down, and that's not showing on CPI. You can see that in the blue thing. Maybe it's gonna be showing in the next sprints, maybe. And with all that high inflation, Fed needed to increase rates. So we have seen in this last year one of the fastest rate increases in history, but now we might be close to the end. Market is expecting rates to top between 5 and 5.25% in 2023. Maybe we are really close. It's expected to. Fed said that they will not cut rates this year, but they are expecting to cut rates maybe in the end of this year, the beginning of the next. Not going back to zero again, but we can have some relief. I don't know. Let's see. So, another important thing, the Fed balance sheet. With all that quantitative easing, fiscal stimulus after COVID, the Fed balance sheet is too high. They have to shrink it. So Fed started quantitative tightening about 95 billion a month. They are shrinking their balance sheet 95 billion a month since May 2022, and they are expecting to continue to do that. They said that for the next 5 years. So that's bearish for the market, but it's something we need to accept and count on that. So the Goldman Sachs outlook for the next year, they are expecting, that's the resume, US, they are expecting for the United States markets likely to avoid recessions. PC inflation slows from 5 to 3% in the late of this next year. Fed are hiking another 75 basis points only to peak at 5.25, and they don't expect rate cuts in 2023 for the US markets. In Europe, they are expecting a mild recession. Actually, they think the Eurozone and the UK are probably already in a recession. They are expecting the European Central Bank to top the rates at 3%. Maybe, we don't know. Let's see. That's bad, but probably. But Europe is in really bad shape. About China, they are expecting a bumpy reopening. That's not bullish at all. They are expecting a slow growth in the first half, followed by a good rebound in the second half. They remain cautious about China because of the property market problems. About emerging markets, they are praising their resilience because several central banks in Latin America and Eastern Europe started to hiking rates before the US. They have been resilient, and some countries have inflation already going down a lot, especially Brazil. They are bullish on Brazil. JPM talked about the emerging markets as well. We have seen emerging markets underperform the US markets over the past decade. Maybe that we can find better opportunities in the emerging markets. US, we are still maybe overvalued, which is difficult to find good opportunities. Maybe we can find it somewhere else. China is still cheap in comparison to history. They have been the Chinese stocks have been recovering a lot, and I'm happy about it because I own a lot of China. Maybe now it's a big, it's one of the biggest parts, or it's a big percentage in my portfolio. Maybe I will have to trim it, but that's good. I like it. Taiwan is not been cheaper in recent history, so maybe we can find some opportunities because everyone is afraid of China invading Taiwan. That may cause some opportunities, and China is behaving well, if you can say that, but they are trying to boost their economy. That's good news for China and for the world. So, and Brazil, it's really cheap as well in comparison to history. Maybe we can find some opportunities. I've been trying to find some, but I couldn't find any good companies in Brazil. Maybe I will stall. Maybe I will continue my research. Maybe I can find some opportunities there. I think it's a good place to look in the next year and for the next years. Now let's talk about where you can find some opportunities. When we look into sector performance over the years, I can conclude that when some sector underperforms the market for 1 year or maybe even 2 or 3 in a row, they tend to outperform in the next years, because when the pendulum swings, they can go from overvalued to undervalued, and when the stocks in certain sector are undervalued, it's when we can find some good opportunities and have some good returns. So it's one way to think about the market. In the last year, 2022, communication service, consumer cyclical, technology and real estate were the worst sectors. So maybe they will outperform this year. Maybe we can find some good opportunities, some stocks undervalued, and maybe that's a good starting point. We can try to find some good companies in there at a discount. And one main thing I can conclude is that technology and consumer cyclicals are outperformers when we have recession or some crisis. So with the rates going down after inflation is tamed, maybe they can outperform the market, and maybe now we can find some stocks in that sectors at a good value. So the JP Morgan scenario for the next year, they are expecting a moderating inflation and a mild recession. In the Fed policy, they're expecting the Fed to increase rates to 5% and stop. Central banks to peak around 3%, and for the Bank of England, they are expecting a peak in interest rates around 4.5%. That is their base case. I agree, maybe the Fed can go to 5.25%, but I think it's a good base case. In the downside, if we have a persistent inflation and a mild or a deep recession, that can be bearish for the market. If the Fed or the central banks are forced to increase rates even more because of inflation is not going down, that's bearish as well and can be really bad for the market. In the other side, if inflation goes down faster than expected, the central banks, the Fed can stop hiking rates sooner. They can stimulate the economy and the growth recovers. That can be bull for the market. It will depend on inflation for the most part in the earnings. If the economy can hold, if the earnings hold, we have no recession, and that increase the market valuation and rates. So if inflations come down faster than we are expecting, rates might come down. We don't know. That will depend on all that things. So, market predictions. Let's talk about it. I don't like to have a market prediction. In 2021, I've read all the predictions from the big banks, all the big brains, and all the analysts. They all were expecting to the market to be between 4,600 and 5,100, and we ended the year at 38. No one could predict what will happen, and that's not what we should do. For the next year, my base case is that we will experience maybe an earnings recession. I think 225 is too high. Maybe you can have between 200 and 225. My base case is for 21, 215 maybe. I'm not trying to predict it, maybe I'm just trying to be a little cautious. With inflation going down, I believe inflation is going down. We might end the year close to 4%, maybe not, let's see. That will be good. Maybe I'm expecting the Fed to stop rate at 5 or 5.25, inflation going down, and you might start looking into the future with brighter eyes. And one thing is, markets are smart. Market is always forward looking, so we might end the year at 4%, but with inflation going down, the market can assume a higher multiple. Let's talk. In my base case, if we have my best case could be if we have an earnings recession, maybe we have 210 earnings. If you can assume a 18-month multiple, because we have inflation going down and we are forward looking for inflation to be tamed and rates coming down, we can expect maybe a multiple of 18. And if you have 210 in earnings, that is a valuation of 3800, which is the value we are starting this year. Maybe this is a year where we are not going anywhere. I think we'll trade in a range. So if we have a recession, maybe in the middle of the year or in the first half of this year, if earnings is going down and the analysts were expecting 200 earnings, if you assume a 16 multiple, maybe we should trade at 3200. Maybe it's a bottom we can go. We will retest the lows of 222 at 3600. We don't know, we will see in the next year, but that's good. But you can always have a bull case if the earnings top analyst estimations at $225 per share. If inflation goes down, the Fed start to reduce rates, and we can we might assume a 20 multiple. If we had 225 earnings and 20 multiple, maybe we'll climb to 4,500 on the S&P 500, which is really good for the market. But I don't think it's probable. Maybe we'll trade at the range where we are at this moment, so it's close to 38, 3,900. Let's see. I'm not trying to predict the future. Even the big brains, all the big banks can't do that. I'm not the only one who, I'm not the one who will do it. So I hope you like it, the video. I tried to bring you a resume of all the research I've read. I've tried to bring the most important things I've read, and my main purpose of this video is to inform you, bring you good information so you can expect. I'm not going to tell you what will happen, what will be the market outlook. I'm just trying to bring you the best information you can have, so you will be well informed and take the best decision you can do. I hope you enjoyed this video. If you like it, like and subscribe, and we'll see you next week. Bye.